just get a little sound check because I don't know. I've been getting that warning more and more. Yes, thank you. Thank you. Think I'm going to have to retire these headphones. I don't like it, but that's how it goes. All right. So today, it's the day we've been waiting for all week. Jackson Hole, the Pow from Powell. Now, last year, I think he learned a little something. You know, you always have this sneaky suspicion of the power that maybe you have, but to see it in action is a completely different thing. And last year, he really got to see it in action. The market has this disconnect going on where they think the Fed is lying, and they've thought the Fed has been lying all year. The Fed has said higher for longer. They've been saying that since Jackson Hole last year. That was the mic drop moment. Higher for longer. We're not cutting. Higher for longer. We're not cutting. And yet the market has been pricing in cuts. They've been pricing in these pauses and the start of cuts by the end of the year. Today, it's very likely that Jerome Powell is going to remind them of his message from last year, higher for longer. And it is believed that the market is not going to like that. And there's now talks of the soft landing not being so soft again, and recession discussions. And it's a path for another day. The main thing today is going to be, will Powell provide guidance on this higher for longer narrative? And that answer is going to affect exactly what happens with stocks. So when it comes to the charts and, patterns and analysis and support and resistance and ADR zones, sure, we can take all of that into effect, but the number one thing is going to come back to Powell and this higher for longer. So we can see if we use FX Street, there's multiple places of a red bar. We are in a hurry up and wait, hold the pattern mode today until he gets out there. But we've also got central bankers from around the world like Christine Lagarde in Europe. We still have data coming through out of Japan tonight, but that'll be later tonight. So we've just got a whole lot going on today, right? Powell's going to be at 10:05 supposedly. Last year he was slated to talk, I believe, for 20 to 25 minutes, and he didn't make it through 5 minutes. He really hammered that point home. We'll worry about next week when we get to next week. Taking a look at the global indices, we're up around the world. Doesn't matter, where you start. But if you think about the progression of markets from 3 o'clock in the afternoon into Globex and then around the world to where we are now, it starts with Australia, moves over into China and Japan and Europe and back to the US. Things that are up the most, China, Hong Kong. Obviously, we just skipped some of these. That Italy's up the most, but I don't want to say Italy's not important, but Italy's not important. Hong Kong, Europe. Then we get into the Russell, which is nice to see that sucker is still alive. And then Japan, the Dow, the S&P, the NASDAQ. That list right here on Finance Juice just about sums it up. It's all talking heads today. Now, when I was newer to trying to figure out what happens when something like the plunge protection team comes in, it's something that you hear about when you're starting to dig deeper into economic events and things that can move markets. And it sounds a little tinfoil hat stuff, right? Like they and them, they are going to save the market. They are going to move the market. Who's these people and what kind of pockets do they have? Because imagine the buying that would have to take place to move these markets. Of course, I was looking at it from a new person's point of view, not realizing that the power of their words can move these markets. All they have to do is imply something, a favorable policy, a more restrictive policy. Today, Powell is expected to be hawkish, so the market is coming in with that already in their mind, that he's going to be hawkish, that he's going to reiterate the message higher for longer. These other speakers today very much need to echo him, right? They're all going to want to stand out and sound like they are their own person. But there's this consistent message that needs to come through. When they all are on the same page and singing from the same hymn book, it's when the messages most resonate. So after Powell today, whether or not these other speakers have the weight that he has, we still want to kind of just circle back maybe over the weekend and dig a little deeper into what they said and make sure it's on the same level, right? If it's not, then we don't really have a narrative to carry forward into next week. Seeing a little more stimulus out of China. It's not wrote as stimulus, right? But if they start loosening mortgage rules or, in some way making policy less complex, less complicated, less strict, that is a form of stimulus. So we can see US dollar Japan broke that 146 again yesterday. It managed to pull back off of it a little bit. But it's still a level of concern. It's still something we really got to keep our eye on. I'm sure even right now, they're trying to figure out when or if they are going to come in and do anything about this. So, just kind of keep an eye on it. If we were to mark out where they had came in before and ran an intervention, there was September and October of last year when things were really getting out of control. And we can see the last one, right? That October 21st on a Friday. Just go back to the S&P on Friday, October 21st, and see what it looked like back then, and then see where everything changed. We're getting back up into that level. So we want to continue to watch any news out of Japan. One of the speakers that's going to be at Jackson Hole is supposed to be President. I'm not even going to try his name. It's that new Bank of Japan guy. I said president. That's wrong. It's the Bank of Japan, the new guy. Ueda. Poor guy. I'm just killing his name. We want to see if he's got anything to say, any hints or any kind of a nod towards intervention at these levels. We're still looking for a cross up. If you're looking for a way to trade that information, right? If US dollar Japan is going to get a smackdown and is expected to say, make it back down into that 130 or 127 zone, if that is the anticipated move, how do we monetize that? If you don't have an FX account trading US dollar Japan, you could trade the ETF FXY. Trade this long if you think US dollar Japan is going to go down, right? So it's an inverse play. You would take this long either buying calls or selling puts, or maybe both if you want to get aggressive with it. But that'd be the idea, right? A way to monetize. And the same thing with US dollar China. We're getting back up into nosebleed levels here. If this does prove to be a bull trap and it comes back down, then the trade on FXI would be the same thing, a cross up. This is a little bit of bottom fishing, right? There's really no signal down here to imply or suggest that we're going to go up, other than that's a really wide head and shoulders that's taken over a year and a half to build, right? I mean, that's a really wide head and shoulders. It's probably going to take another year and a half for it to play out. In the shorter duration, just going from say 27 to 30 would be a nice play. If we do see, US dollar China reject it at 7.3 and maybe come back into 7.1 or even 7 flat. So when we're going through, these currency pairs, even if you don't trade FX and you're just an options trader, that's still a viable opportunity. No reason to sit out. TLT is another one. Not only are we watching it constantly because we're really focused on that 92 level, but there is this very strong belief that the bond bulls need to get in here and kind of step up their game a little bit. Well, if that's the case, that'd be a trade long, right? At least we have a TRB setting up, and it's a weekly TRB. With gold and silver and the miners, if US dollar Japan takes this smackdown and we start seeing, a move towards 137 or 135, then you should be able to play silver, gold, the miners to the upside, right? We've been kind of stalking those for the flip, right? Time for them to go long, and we're still waiting. We don't have a good signal. All right, I don't see anything in here for the afternoon. It's all those Fed speakers. So this rig count very likely isn't going to have any impact in the market. The rig count doesn't change very often unless something drastic goes wrong with the fleet. One or two rigs here and there, it's not really a big deal. And I say that over and over, but there is one thing that I really don't mention very often, is that the number can trend, right? Just like anything else. So week after week after week, if that number continues to go down or continues to go up, that the total number of rigs might change by 1 or 2, 3 rigs, but it continues to trend in a particular direction, then that number still matters to people, right? And it still has weight, and it still means something in the bigger picture. My point every time I say that number isn't going to matter is that if last week it was 270 and this week it's 272, the addition of those 2 rigs isn't going to send the market into a tailspin, right? That's kind of my point. So the number does matter in relation to what it was versus what it is now. All right, the volume is a little heavier than anticipated on a day where we're supposed to be in hurry up and wait mode, sitting at 91,000 at 7:30. It's normal levels, and we wouldn't expect normal levels on a hurry up and wait day like we have today. We do know that they're hedging. This isn't, a hypothesis. We're not assuming that they are hedging. They are hedging. We know that because there's market maker move this morning. Market maker move is formed when the options in the front end are traded more than the options on the next level out. When that happens, the number in the front becomes higher than the next number out, and that gives you market maker move. I'm going to squeeze these things together so that we can see that those two numbers, it makes it easier. So when I do that, we scratch out the -1, right? Because that was Thursday and it just hasn't been taken off the board yet. We look at the 0-day, it's at 17.5. I'm just rounding. And the next number out is at 13.25. So that difference right there is where market maker move comes from. It's why we have that show up in the first place. Supply and demand is the reason that that went up, but also activity. This is average implied volatility for the options within this options chain that are out of the money. So it adds up all of those out of the money options on the put side and the call side, and then gets the average of that. And that's where that number comes in. Well, that implied volatility in the options chain changes by how fast the price changes in these options, right? Because if you think of implied volatility out on the candle chart, it's using candle close to candle close. So the closing price of those candles. Well, we don't have that here. So this implied volatility has to come from something else. And it's coming from the last traded price. So if that keeps changing and it's changing quickly, then the implied volatility will also start to change. And that's why we know they're hedging. They're coming in and they're trading in the front end. And it's out of the money stuff, because that's what affects this thing, is out of the money stuff. And we take that number and we add it to the regular move that we already would have anticipated, right? Every market has an expected move. It has an expected move for a day, an hour, a week, a month, a year. So on a day-to-day basis, we can look at the expected move. Today's number, for an example, is 44.11, the COG line, and then 44.37. And above that, we would add another $24 or another 0.5%. And that gets us to around 44.50 area. We got a voodoo line at 44.59. So we'll just use the drawing tool and we'll add another $24 and see what we get. It doesn't have to be perfect, right? No reason to stress on it. That gets us really close to yesterday's RTH open. I would use that level, 44.63. That works perfect. And then we just do the same thing to the downside. The ADR is 43.57. Then we have the previous week's low at 43.50. Then another COG line, 43.31. And below that, we'll add, or we'll take off another $24. Call it 25. And that gets us down to the voodoo line, 43.07. It's actually a little more than that, but voodoo would interfere, right? We'd get to 43.07, 73, 75. So that's our level or our range for today. The thing is, the phrase is either or for a reason. We could either go to the bottom or the top, or both. As crazy as that might sound, the markets have done it before. It can certainly do it again. And how we end the week this week matters a lot. One of the things that matters is that we made it through that 50% level of last week, and we weren't able to keep it. We fell back down below it. Now, as long as we're still inside last week's level, then it's not too bad. But just the fact that we got through that level and we weren't able to keep it doesn't bode well, right? That's not healthy and positive to have given that back. But still, if we can manage to close holding inside of last week's level, that's a great start. It's a great start to a turnaround that we've a lot of us have been saying is coming, right? Very much like back here when we were still a part of this downward move. That was a pretty decent pullback. All right. And then we finally came out of it and up we went. And before that, when it was back here, right? So even if we have a big week and then we do close, near those lows, notice on every one of these though, we still managed to close inside that big week. So last week's low is important here. We still have those major moving averages as well. There's the 20-week at 43.50. If we go to the downside, I already mentioned 43.50 is one of those levels that we have to watch. It's Friday's low, basically. So if you're just using pivot points, you can look left and realize Friday's low. It's just about the right spot. So that'll do, right? It's good enough. No reason to stress. So previous week's low or the 20-week moving average, whatever. It'll do. Take it out to the daily. There really aren't any moving averages underneath this until we get all the way down to the 200. And that's not our focus today. So on the daily chart, really the only moving averages that we have to worry about are if we move up. So we got the 10-week over our head, or excuse me, the 10-day at 44.20. And then we have the 20-day at 44.74. And we do have that 10-week over our head too. So we're kind of pinched between these moving averages. All right, at this point, we've basically lost the pattern that we had here. If we were going to call it anything, it would be a classic D shape. Although it's pretty much like a chewed up piece of bubble gum at this point. We've moved through the shallow zone multiple times, so now the zone isn't so shallow, and there is a lump in the middle of it around that 44.50 area. It was interesting that we had such a shallow spot before, and I had pointed out that it was 44.50. It was a surprise to see it so shallow at a key level. Well, they finally activated whatever trade was sitting there because it filled up, right? So it's not the point of control yet, but it certainly was working on it, even for the small amount of time that we spent there. Right now, we're sitting right in the pocket of a shallow area, and we've got a price shelf above us and below us, the cog line 44.11 overhead and 43.80 below us. And there's nothing else down there. If we happen to break that shelf, we can very easily go to Friday's low without much interference. All right, I talked about leaving on that VPOC yesterday because I just wanted to see how it was going to react. And I mean, we're certainly through that at this point. So just take those off the table. There wasn't much of a reaction there, I gotta say. It wasn't necessarily disappointing. Just I thought it would do a little better. It didn't. We now have a VPOC overhead at that cog line. Pretty much, right? I mean, there's no reason to stress on it. It's pretty close. So if we continue moving to the upside, 44.09 is a VPOC level. We did come down yesterday and hit one of the lower levels, but with the pace and just the scope of the move, it was so fast that there was no slowing that thing down, and it ran right through it like it wasn't there. hopefully you guys were able to monetize that move yesterday, right? There was one chance where it tried. And if you go back and you study days that look like this, because a lot of people tell me, I want to trade the days that look like that. Okay, then you want to go back and find as many of those as you can and study their characteristics. If you do that, one of the things that you're going to start to pick up on is that pause right around lunchtime between 11 and 1, where the market's trying to decide, hey, are we going to flip this thing over and run it back up again? Or are we just going to go ahead and stay the course and keep going to the downside? And that's the choice, right? There's always the third one. Don't get me wrong. There's always the third one is where you just stay there into the close, right? But it's like A, B, or C. What are we going to do? So it made one attempt to flip over, and that was it, right? So it wasn't hard to identify the failure and the fact that it was just going to continue moving to the downside. Once it broke that range, we knew it wasn't going to be, option B, go sideways into the close. So if it's not going to be that, and we're obviously not going back up, then we're going to continue to go down. Made it pretty clear too, right? There wasn't much subtlety to stay short. That's pretty much the message that I was giving yesterday. So now we have this very narrow range, right? When we look at the IB, which is initial balance, IB, it is an open range that lasts for 1 hour. The difference between this and an open range is I can choose whatever open range I want. If I want a 5-minute open, a 15-minute open, or even just a pivot low, pivot high, I can do that. But when it comes to initial balance, you don't get to choose. It's 1 hour, and it's supposed to be in the Globex between 6 and 7 at night. However, it's really becoming a more popular thing to be at 9:30 in the morning at RTH open from 9:30 to 10:30. Now, look, things change and people can adapt it for whatever they want. I'm a shining example of somebody taking something and adapting it and making it my own. So, the fact that somebody took IB and made it popular in the RTH is awesome. And it doesn't mean that they're wrong, right? The classic one, the original one that was made way back when, was designed to be in the Globex from 6 to 7. That range has a lot of information in it. How wide it is, for an example, kind of gives us an implication on whether or not there's still work to be done. We call it unfinished business, right? At least that's what I like to call it. If the range is really narrow, there's a lot of unfinished business because the work hasn't gotten done yet. If the range is really wide, then it does imply that a lot of work has gotten done. And whether there's still more work to do or not, we don't know. But we can look at the wide range and we can say, yeah, that's really wide. They got a lot of work done. Maybe they're done completely and we're just going to stay in that range for the rest of the day. However, when it's a day like this, when we're all waiting for an event, that narrow range doesn't really offer us that kind of insight as much as just compression. So putting something like the RSI Laguerre on here and seeing how much gamma we have doesn't do us a whole lot of good. We know the market is primed up with a lot of capital ready to go and it's hedged. So if you're thinking today can be some big, amazing blowout move, you're right, it can. But if people are hedged to the eyeballs, they don't have to sell. They don't have to buy. They don't have to manage their trade because they're insured. They're protected. So usually what happens is the more everybody says, oh, it's going to be a big move, the less big move we get. Right? Because once everybody starts saying we're going to get a big move, they run out and they trade for the big move. They price in the big move. and then we don't get one. It's quite a dud afterwards. So I'm not saying that today's going to be a dud. I'm just saying that, it doesn't have to be a big splash. And their main thing is going to be if the markets are offside. Because if they're caught by surprise or if they're offsides, that's where we're going to get the biggest moves out of the whole thing. And the reason I took my time kind of going through all of that is because there's really no reason to go in and look through the watch list today, right? If the market turns bullish for whatever reason, it decides that Powell is just senile or something, and they don't want to listen to him, and we start to go up, then everything's going to go up today. All the fangs are going to go up. The financials, which are really, kind of surprising sitting at their location, they're going to go up. It's going to just be a buffet of long trades. And on the other side of that, if the market uses today for an excuse to finally start dumping out of some stuff, everything's going to go down. I don't think there'll be very much out there to choose for a long trade. There's always a long trade somewhere, but it won't be, a buffet of choices. So I took my time going through that other stuff because there's really no reason to go in and nerd out on anything that's in this list today. It's all going to come down to Jackson Hole, to Powell, and to the market's reaction of Powell. So one thing that you can do if you have Thinkorswim is you can go to the Visualize tab, and you get to choose what you visualize, right? So here's the heat map. It's not as worthless as it appears if you are kind of new and you look at this and you think, well, that's freaking worthless. That's what I thought when I was new. I thought, that, who would use that? That's what a waste of my time. That wasn't true, by the way. That thing has a lot of value to it, but skip that one. Up in the top, you got heat map, but you also have an index watch. The funny thing is, you can put anything in here, your own personal watch list, for an example. But you want to put an index in, and they are detachable. So you can kick that thing off, pin it so it doesn't fall behind, move capital over so that it's issues and capital side by side. Volume is important, sure, but when we're trying to keep things compressed and tight and organized, we just want issues and capital. Now, if I hit copy, the next one is exactly the same size as the first one. The only thing is we got to scoot it over a little bit for the volume in the capital. Right, so we'll just leave it wide enough to see both. Now you pick your index, the S&P 100 for an example, the NASDAQ 100. You can do the Russell too, and the Dow, and then you can add in something like the NYSE. Load that thing up, and what you're looking for on a day like this is that rising tide or that falling tide. How many names out of the 100 are moving up or are moving down? Remember, since it's a round number like 100, whatever number you get, you can normalize that into a percentage. So if advancing issues is 60 advancing minus 40 declining, you can say 60% of the NASDAQ is advancing, right? Or 40% is declining. So it makes it easier to normalize when it's one of the 100s. You can use the S&P 500, but really there's no benefit, right? We all know that the 7 monsters run that S&P, right? And the rest of them are just weight. All 93 names combined can't gather up enough to buck the system against whatever the fangs are doing, right? So looking at the S&P 100 versus the S&P 500, we're still either going to ignore 93 names or 493 names. Load these things up today and keep your eye on the sway of the market through the bigger lens. All right, how many of these names combined are going up or down? Because remember, he's not talking right away, right? There's going to be a wait while we're doing this hurry up and wait until he gets out there and gets to doing his thing. There's still a lot of bricks in the wall of worry. This is just one brick, right? We still have FOMC. There's an issue with the NVIDIA. Not even getting into that yet, but something with BlackRock and NVIDIA. Some kind of shady stuff going on over there. So today, just approach with caution, be careful. For you 0-day traders, really, even though there's all those speakers in the afternoon, I really think that whatever the market chooses or however the market reacts to Powell, that it won't flip halfway through, right? So if we're looking for one of those days where the market does a half a day down and then a half a day up, or a half a day up and a half a day down, I don't think it's going to be like that. I think it'll be a lot like yesterday, where the market picked a direction and maybe paused along the way and then just kept right on going, up or down. I'm not even going to try to, pick and choose a side, but it's very likely going to be something like that, right? Just also keep in mind, the market doesn't owe us anything today. It doesn't owe us a rally. It doesn't owe us a fall. And the only thing it needs to do from a technical analysis standpoint is it just needs to hold above 43.50. And that's not a very tall ask, right? Out of all the things, that we often require out of the market, asking for that isn't asking for much. One chart I didn't hit, but I think we should go ahead and do it before I wrap this up, is the daily chart here with the weekly expected move. One thing that is cool is we have next week's range, right? Now it's not set in stone because this week isn't done yet, but we can take what we have for this week and then we just scoot it over onto next week's levels. And we can see that next week really isn't much different in the size of the range, which means the volatility for next week isn't different than it was for this week. That can be for a number of things, but one that stands out to me is if the volatility increased because this week was Jackson Hole, why is it still increased next week? What's on the agenda for next week that would cause that to stay elevated like that? The next thing that we can use this for this week is the idea that we're back in the box. 44.40 is the top of the weekly expected move, and 43.20 is the bottom of the expected move for the current week that we're in. And we should close inside that range with an 80% accuracy. It's been a while since we've been, well, we had one last week, but it's been a while since we've had multiple breaches at the end of the week, right? So if we close outside this range this week, that'll be 2 weeks in a row of outside the box. We'll see how it goes, right? Just remember all those moving averages from the higher time frames. No matter which direction we go, up or down, we're going to hit something, right? We're going to hit moving averages going up, or we're going to hit the 20 period weekly if we go down. Everybody have a good day. Have a good weekend. I will see you all next week.